Our next guest says, do not fear the bears. The bulls are going to eventually come out on top. Let's bring in Citi's chief U.S. equity strategist, our friend Tobias Levkovich, who says there is a 90% chance that the markets will be higher 1 year from today than today. Why so optimistic, Tobias?
Hi, Brian. So let's step back for a minute. Back in September, everybody on the street was bullish. Our panic euphoria model, which is our primary sentiment metric, was signaling 70% chance the market was going down, but everybody's talking about 2,900 going to 3,100, 3,200, 3,300. That was the kind of voice that was going there. And when you worried about trade, not really, because everybody was still buying tech, which is in the crosshairs of the IP kind of transfer, forced transfer kind of debate around trade. So it was fascinating to me. And today we're sitting in an environment where that model is almost in panic territory. We're not there yet, but it's still signaling better than 90% probability of markets being higher. At the same time, some of our valuation models are generating the same kind of condition. I've heard comparisons to previous periods, 1973, 74. Oil prices tripled on a war in the Middle East with massive inflation, crushed the economy. It's just not the same environment. It could happen, obviously, but you're betting on a scenario that may or may not happen, and we got to move away from that. You want to go back to 07, 08 and the banks, last point, 07, 08, the banks and all that, credit was coming apart at the seams. If you look at credit conditions today, not anywhere close to that. Nowhere.
Are they cracking it all, though, Tobias? The one thing we've talked about, I'm kind of the oil and gas guy, so forgive me for focusing on that. $240 billion in oil and gas debt maturing globally over the next 5 years. We're starting to see any cracks in high yield at all?
So in high yield, you are seeing it. You've moved 100 basis points on credit spreads widening, and that's been heavily influenced by the credits in energy. Remember, energy is about 16-17% of the high yield market. It's about 5-6% of the S&P 500. So let's keep those two separate. Go to IG, kind of investment grade. It's moved 50 basis points. And keep in mind the 10-year yield moved in 40 basis points. So actual corporate cost has gone up 10 basis points. That is not cracking credit. It just isn't.
I got a quick question for Tobias, if I could. Tobias, back in January 2015, you put out a piece and you were talking about the volatility index, something we talked about earlier. You said it's never a buy, or it isn't a buy, actually, between the levels of 20 and 25. Do you stick with that right now? Because I know you did back in 2015. Do you believe that now as well?
I do believe it, but it's got to stay there for more than a few days. And that's the key issue, where we have volatility, so this stuff moves around. What I will tell you is if you do correlations, and I know people don't like to do math, but if you do correlations on the VIX relative to future market outcomes, the correlation is particularly poor. It is a great coincident indicator. It's not a future predictor of great value. It's not consistent over time. If you do things that are a little bit more intriguing, like looking at premiums paid for puts versus calls, if you look at both margin debt and short interest, if you throw in on top cash positions that people have, if you kind of build much more robust models, then you get those 90% probabilities, or back in September, 70% chance of losing money. So you've got to kind of get something a little bit more, I don't know if the right word is robust in terms of the structure. Single correlation, single factor correlation could break down at any point in time.
Tobias Levkovich of Citi, remaining optimistic out there. Tobias, thank you very much for your time. We always do appreciate it here. Guy Adami, he's bullish and he's optimistic on credit.
He's a stud. He's one of the, if there was sort of a pantheon, he's right at the zenith of the pantheon.
That's a lot, right there.
With that said, in my opinion, something changed in October. We went from a 10-year market where you buy every sell-off to now it seems like every rally's being sold. That's a fundamental change in the market for the number of different reasons, many of which we talked about at the top of the show.